Go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, Simon Ree, returning guest in his now usual slot on the podcast. He is the best-selling author of the book, The Tao of Trading. Simon, how are you?
Hey, I'm really well, Rocco. How are you?
I'm great. Simon, the Jackson Hole Symposium, I guess, has come and gone. It's big news, and then we sort of move on quickly. Let's unpack that a little bit today. Jerome Powell's statements, hawkish, dovish, opinions seem to be split. I think you can make arguments both ways. How would you interpret it?
Powell provided, to be honest, very little in the way of new information with his Jackson Hole speech. He commented that policy remains well positioned. He and most of the FOMC believe it may be appropriate to start the taper this year. And really all of that was just confirming the July minutes. I think one thing that Powell did quite successfully was he decoupled the idea of tapering from the idea of interest rate rises. So the language he used was that the timing and pace of coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. All right. So I think what he's done is he's avoided the taper tantrum that Bernanke suffered in 2013 when he started talking about the Fed tapering asset purchases. Because back then, when Bernanke started talking about tapering in 2013, bond yields ripped higher, and the market kind of assumed that tapering was somehow conjoined to rate rises, and Powell has made it very clear that they're not. His language was pretty flexible, that they allow variation in timing according to economic data. And in fact, Powell did say that they would need to see robust jobs figures to begin the taper. And then, as if by magic, ADP missed quite significantly last night. Came in at 374,000 versus 500,000 expected. Yeah. So, a lot of eyes will be on this Friday's jobs number. And if that does come in, stronger than weaker than expected, remember the last 2 months were pretty strong, you could see the tapering can get kicked further down the road.
You see, because to me, it's I was asked hawkish or dovish, and I'm saying neither. It's neutral. It's nothing new. It's not positive or negative. It's just it just is. I think you're right. What he did is he basically calmed that concern about tapering, and this might be a different variation from the past. It's like, okay, but it's like saying, okay, this time is different. Do you think it's really different?
No, look, I don't, but I think it's different from 2013 because I think he's successfully decoupled tapering and rate rises. I think the market can probably live with a gradual progressive taper.
Because the market's been higher, right? I mean, there was a very sharp and obvious move higher, and contrary to what was expected. So, I mean, that market being forward-looking does give you the indication that there's some sort of rationality behind this.
But rate rises is probably a much more difficult proposition for the market to live with at this juncture.
Yeah.
So, I think that when you look at Powell's tenure, he presided over that kind of almost bear market we had in the fourth quarter of 2018.
Yeah.
And you could form an argument that he was kind of responsible for that. This is when he was talking about Fed balance sheet is in reduction, is in automatic pilot, and the S&P dropped. It was like 19.9% from October to December 2018.
Yeah.
And that was really just Powell. That was a massive public relations exercise for Powell, and he doesn't want a repeat of that. He also, he didn't obviously cause what happened in February, March last year, but he was the Fed chair that presided over that event.
Yeah, he didn't help.
So he's, he's got first-hand knowledge of what stock markets are capable of, and I don't think he wants to preside over or be blamed for a massive bear market. So I think he's quite well aware of that. His history as Fed chairman would back that up.
Yeah, if he's going to telegraph it, that would be most likely the worst case scenario. So, I mean, one of the things he likes to say is inflation is transitory. We've heard it so many times now that we need to start asking, listen, is that really the case? And are we correct in being obsessed with interest rates?
Let me tackle the transitory question first. Yes. I'm a little on the fence here. I mean, he's got a good case to make in that when you compare inflation statistics today with 12 months ago, 12 months ago we were in the grip of a deflationary shock. I mean, we kind of the comparisons are getting easier now, but certainly the last few months we've been comparing a healing economy with an economy that was going through a massive deflationary shock with global lockdowns. So from that perspective, that there's a pretty good argument that maybe the inflation numbers, the official inflation stats, are transitory. But what we're seeing is, rising prices on big ticket items due to supply constraints are reaching painful levels. And in fact, the University of Michigan buying conditions for houses due to prices, which came out last week, are the most adverse on record. So inflation is certainly appearing sticky in certain areas, housing, big ticket items, that there is signs of sticky rather than transitory inflation. And a lot of this is due to supply chains that have been busted. And if the Fed is working towards maximum employment, which they said is really the cutoff to start interest rate rises, with supply chains that are struggling to keep up with demand, you certainly could see a recipe where inflation becomes sticky rather than transitory. So I think it's something we need to keep to watch. We need to keep watching. And
but my feeling is that there's a concern that it's a bit decoupled from reality, because he speaks about inflation jumping into other markets or other bundles of things, and are they maybe not looking at the real world on the ground and maybe just looking in theory? You know what I mean?
Well, I mean, they're looking at PCE, right?
Yeah,
and I think they're pretty myopically focused on a fairly narrow set of criteria in terms of how they measure and track inflation. And to your point, I don't know that they are.
Because if you speak to, sorry,
what's happening in the real world,
if you speak to the real guy on the ground, like your dispensable income is getting smaller, like because everything is getting, and when I say everything, is like your basic basket of goods are getting more expensive. So to say to me, inflation is transitory, yes, maybe in a like a theoretical model, but it's disingenuous to the person on the street who can't afford, have to pick up a second shift to go and work or whatever, that can't afford a certain standard of living anymore.
I think you're completely right, Rocco. Unfortunately, from a policy perspective, it doesn't matter. The Fed doesn't seem to really care about that. And I mean, what we've seen since 2008 is a massive inflation in central bank balance sheets. And it's not just the Fed, the ECB, Bank of Japan, they've all been at it. They're all as bad as each other. But this balance sheet inflation doesn't happen in a vacuum, all right? It does inflate asset prices. And what we've seen is a massive disparity of outcomes between those who own assets and those who don't. Those who are reliant solely on income are getting badly left behind, and those who own assets and know how to play the game are making the most of it.
And I guess this is going to get worse when they raise interest rates, right?
I think raising rates is going to be problematic, because we're in a situation now where we're potentially the growth acceleration has stopped. Growth is starting to decelerate. US PMIs are starting to stall. Chinese manufacturing PMIs rolled over. That's now below 50. US yields are potentially signaling a peak in growth. So if growth is peaking, supply chains are kind of still busted. and the Fed starts to raise rates, I think that is problematic, on a number of fronts.
Yeah. Look, let's shift gears a bit before I let you leave. One or two companies that you're keeping an eye on in the short term, or sectors that you're maybe looking at for the listeners that they can go and look at?
My favorite sectors at the moment, and I focus on the US market. Tech obviously has been great. Communication sector has been great. Semiconductors is one that I like, and healthcare. But of the four, three of them to me look a bit overextended. So tech, communications, XLC, semiconductors, SMH, they're a long way away from their mean. Okay, that they are extended to the upside. And look, I'm taking a trading view here. I am a trader. Yeah. I would be looking to buy pullbacks on key components of those sectors.
Makes sense.
I think you buy the dip. We're still in a buy the dip environment. I would be looking at things like Google, Facebook, Apple, Microsoft, Shopify. They'd be some of the names that I would buy on a pullback to the mean. In the semiconductor space, I like AMD. I've got exposure to AMD at the moment. I think that looks set to resume its uptrend.
Even Nvidia did very well, but you're not concerned about a shortage of semiconductors, right?
No, look, you're asking the wrong guy. I don't really look at fundamentals.
Sorry, I forgot for a moment that we don't care.
Yeah, I try and forget what I think I know about situations like that, because for sure. You look at the healthcare sector, though. That looks a little bit less extended. It's still in a very, very nice uptrend, and things like Eli Lilly, Pfizer, they look pretty good to me here.
Yeah, that's pretty much what I have as well. Listen, Simon, for the guys that want to, and girls, I must say our girl demographic is very, very good, that want to catch up with you and connect with you. I believe you've recently started a YouTube channel. Where can they find you?
Yeah, I have. So YouTube channel is called Tao of Trading, TAO of Trading, and I'm aiming to post updates there 2 or 3 times a week. Just short videos about things that I think are interesting, topical, and could move markets.
That's excellent, Simon. Thank you so much for joining us. To our listeners, peace, love, and prosperity, and we'll catch you in the next one. Cheers.